Today we have with us Subbu Rama. Thank you, Subbu, so much for joining us today.
Happy to.
And today we're going to be learning about two companies. One is Social Stock, and the other is Bitfusion, and some of the lessons that Subbu learned from selling the first and how that applied to the second. So why don't you kick us off with kind of what the idea was with starting Social Stock and transition into kind of what the acquisition experience was like there.
So I'm just going to give you a little bit of quick background and context so that, it applies, right? I came to this country in 2003 to study. I went to Madison, Wisconsin and did my engineering, then moved to Austin to get a job at Intel. I came from India and I worked at engineering at Intel for about 7 years, and I always wanted to build my own company. My dad was also sort of an entrepreneur in India, so I always seen him build a company, and my mom never wanted me to actually run build a company. But I always had this itch, and I was on a visa here, so I couldn't actually start a company until I got my green card. So the minute I got my green card, around the time when iOS and Android, everything was very popular, me and a buddy of mine, we were reading a book called Unincorporated Man. And this book is about what if the whole world is a stock market, and how could people buy and sell equity in people. So it's a very interesting book. Basically, the context is basically the difference between going to Stanford versus a community college is how much stock you sell. So me and my buddy, we said, hey, why don't we build an app around it, right? We got influenced by the social network movie, Facebook and everything. So, okay, an iPhone and Android was very popular. So we hacked our way and we built an app. And we put it out to our friends, people, 3 months, not more than 300 users. So not much of a success. So we kind of pivoted that. And around that time, he didn't want to pursue the app, for too long. So I kind of took over the IP from him, and I tried to still hustle and, try to see if I can pivot it. We tried to pivot it to a loyalty application, selling loyalty solutions to small businesses in Austin. So we were selling loyalty to places like Dominican Joe's, Austin's Pizza. So we were basically a digital loyalty solution using Social Stock as a backend. Around the time, I got introduced by a friend to a guy in Silicon Valley who introduced me to a VC. And he basically told, hey, why don't you move from Austin to Silicon Valley? I'll give you some money. So I just left my job and then I just moved from Austin to Silicon Valley. And just sold everything that I had here, went with 2 suitcases, crashed with a friend there, sort of living the dream, right?
Yeah.
And I had to pivot the company because I had about 50 businesses in Austin. When I go to Silicon Valley, I had to start over. So pivoted that company into a marketing automation company, selling marketing solutions to companies like financial institutions. And what I was selling, and I had built a small team around me by that time. I convinced another person to also move with me to Silicon Valley, and I was selling marketing solutions where, hey, if you had $100,000 in marketing, do you spend it on 100 people or 10 people or one person? So again, it was a solution that I had built, Social Stock, which was basically like a multidimensional social graph. I was trying to find the right problem, right? So did that, went to TechCrunch Disrupt, presented at TechCrunch Disrupt, and to be honest, I bombed the pitch. After the Disrupt, could not raise any money at all. So kind of spending my own money, trying to, work my way through. So the biggest lesson I learned in that overall, and in the end, I had to pretty much, get rid of the assets. So it was not a great acquisition or anything, but, I had to get rid of the assets. We had a potential acquirer who wanted to buy us, but we walked away from it, and it was a whole thing. But then the biggest lesson I learned is survival. So, the difference between success and failure in a startup, in my view, at that time I learned was survival. If you're in the game, you will always win, but you got to be in the game first. So the biggest lesson I applied from Social Stock into my second company, after Social Stock, I had joined Dell. I was working, for the CIO there, building innovations there. And the biggest lesson I learned after Dell and when I started Bitfusion, I had an idea that I had worked on something about 10 years ago that came back. The thing was, hey, we just need to survive. So built it in 2015, ran for over 4.5 years, and we survived. And, I think everything else matters to that.
Yeah, I love that. So talk to me about how you came up with the idea for Bitfusion.
So Bitfusion, we did at Bitfusion was virtualization of GPUs. So we were providing infrastructure management for GPUs and other coprocessors. So very similar to what VMware did for x86, we were doing the same for GPUs and other coprocessors. So the idea came about when I was reading an article in 2014 by the Intel COO called Diane Bryant. I had worked at Intel, as I mentioned to you in the past. I had worked at Intel. I had the opportunity to work on the integrated graphics at Intel, the things that we have in our laptops, which goes with the CPUs. I had worked on the very first version of that. So I'd seen how powerful it is. In fact, Intel sells more graphics card than anybody. People don't know that because in every laptop, every CPU, there's a graphics card attached to it, and Intel sells a lot more of those. And in 2014, this article, Diane Bryant said is, hey, Intel is going to release a chip with an FPGA in it. An FPGA is a field programmable gate array. It's basically like a circuitry that automatically morphs to anything you want at runtime. So you can basically make it do speech recognition if you want. You can make it do video processing if you want. It's basically hardware that morphs. She said Intel is going to release this in 3 years, and it's going to be with every CPU. Something that kind of connected back in my past was, when Intel released the integrated GPU, it became a big thing. It became very popular. And everybody thought this is going to be the next big thing. So then I said, I need to write software for it. I didn't know exactly what kind of software, but I said, I need to be able to write software to make people easy to use, make this exotic hardware available to normal people, sort of supercomputing for the masses. And I pinged a few friends. I pinged about 4 people. 2 of them said, hey, are you crazy, like wanting to do an idea or a startup? They didn't even want to basically, partner with me. Like, it's not like I had a great exit, right? So 2 of them said, oh, yeah, I kind of want to do a startup too. They were in large companies, and they became my co-founders at Bitfusion. And I'd become smart, from my prior time in survival. So I pinged another guy that I had known from the past, and he connected me with a VC in the Valley called Data Collective. And, met Matt Ocko, who was the VC at Data Collective, and he liked the idea, and a few others that I had known in the angel network, they liked the idea. They said, hey, I'll put some money in. And then we said, hey, okay, let's, quit our jobs and try to do this full time. So that's kind of how the whole genesis of idea came. What we ended up 3 months after we started the company was very different from the original idea.
Yeah. So what did you find product market fit doing? What was kind of the competitive advantage after that 3-month period?
The competitive advantage that we found was GPUs are there in the market. Everybody were actually using GPUs, or not a lot, like enough people were using it, but GPUs were very expensive. And people were not using the utilization of a GPU was very low. So you buy a GPU for 6K, 7K, now it's about 13K to buy a GPU. You buy it, but you only use it about 25% of the time. You waste a lot of those. So the opportunity that we saw was, hey, kind of like what VMware did about a decade ago. They said, hey, you can take a CPU and slice it to smaller pieces and make more people use the same CPU, sort of get more bang for the buck. We thought we could do the same for GPUs. And that's where we saw that. And the value we were providing to customers were, we're going to help you reduce your cost. And we were selling to IT departments who wanted to set up GPU as a service. And they liked what we have because there was no solution which helped them reduce the cost of their GPU infrastructure, because GPU infrastructure is already very expensive.
Got it. Was there a lot of competition at the time?
In fact, to be honest, the way we were doing it was very unique. So virtualization happens at different levels. Virtualization can happen on a hypervisor, or virtualization can happen sometimes at a container level. But what we were doing was we were doing everything in a user space, which means you do not have to change your infrastructure. You do not have to change your applications, and you can still use Bitfusion to slice and dice a GPU or attach a GPU over the network. We didn't have any competition for the longest time. And that's initially because the market was not big enough at that time. I mean, this was 2015. I'm talking about this was before the AI deep learning craze. So nobody thought GPUs were even a market. In fact, initially, some of the VCs I had spoken to, they thought that GPUs, you cannot build a company with GPUs. You cannot build a business with GPUs. And nobody knew AI was a thing. And 2016 happened when AI started becoming really popular. And then people started using GPUs a lot more. And if you see the stock of NVIDIA, it'll kind of mirror that. If you look at 2015, 2016 beginning, NVIDIA stock was pretty low. And 2016 is when their stock just skyrocketed. And around the same time, everybody started using GPUs, everybody started buying GPUs, but then the same problem, it's too expensive. Your utilization is low. So that's kind of how we saw the big product market fit.
Got it. So you operated the company for about 4 years, 5 years?
4.5 years.
Got it. And at what point did you start thinking maybe we should take some chips off the table?
So we never had the intention to sell the company, because I think companies are never sold. Companies are always bought, right? I think people should always have optionality. So the thing is, you never run out of money, but always have options. That way, at every decision point, you can make decisions, right? So, for example, we were not planning to sell. We were going to do a Series B round, and we had a term sheet, and people were we were going to raise the money. But around that time, VMware was a great partner for us. Dell and VMware, we've been working with them for a very long time, and they said, hey, it'd be great if we can take you guys and the product and kind of attach it as part of our solution and deliver a much bigger value to our customer base. And we like that, and that's kind of how this whole thought process saying, okay, maybe this is not a bad idea.
Was VMware a customer?
VMware is a customer and also a partner, so we were in the market together with a lot of joint customers as well.
And how did they make the acquisition offer to you?
It was a very, acquisitions never happen just like, hey, nobody picks a phone and say, hey, by the way, I want to acquire you, right? Never rarely happens that way, right? You kind of work with them for a long time. The sales people love you, the sponsors love you, the marketing people love you. You go, you publish a lot of things together. You go and sell a lot of things to help, make a lot of money for your, acquirer initially. And they initially were looking at investing in us initially. And then at one point, they said, hey, maybe, would you guys consider us, acquiring you guys, right? It was kind of a gradual thing. It didn't happen like overnight. Yeah. And then, of course, we had to make a decision, right? Because it's not an easy thing for us. Right? It's not like, hey, they say, we want to acquire you, and say, okay, yes. So we had to have a conversation among us and say, okay, because choices to make. Again, as I said, options, right? The option is we can either raise another round of big capital, and we already had everything lined up, and go and do a B and go build as a standalone company, or go and be part of VMware, and then go and kind of go and take a different direction, right? The reason we decided on the acquisition was because we saw that the product is going to have much wider deployment and market penetration if it gets integrated with what VMware has. VMware already has a lot of customers, and a lot of people already use CPU virtualization, and they're all buying GPUs. Now imagine we become the GPU virtualization power for that, right? And that's where our whole thing was. And the money is definitely a good thing. Of course, at the end of the day, you have a fiduciary responsibility for the shareholders, and the investors. Everybody should make money, like good multiple. But more than that, it's the product that's getting deployed everywhere, right? Much wider adoption of the product. And number two, they have a much bigger checkbook than we can ever have, right? So we could do a lot of things that we may or may not be able to do staying as a standalone company in a short time. So those were the decision points that we took as to why we, want to get acquired.
How many co-founders were there?
3 of us.
3. Were all you guys on board with the acquisition?
Again, it was not an easy thing, right? Because it's not like we don't say, okay, we want to get acquired, okay, let's go and acquire. You evaluate, right? You look at options. You kind of convince yourself this is the right path, right? Because when an acquirer basically puts an offer to you, the way it happens is they generally talk to you, and then they give you a term sheet. And usually it's a non-binding, but it has usually a 48 hours or 3 days, depending on the leverage that you have. And then there's a whole due diligence process that happens, and then they basically acquire you and give you the money. So the deal can fall through any time. And acquisition is also a distraction, right? Because when you're going through this process, there's a lot of legal work and all these other things you have, which means if things don't go through, you are actually you may be in a worse spot than where you are before, right? So those were the questions that we had, like what is the probability this is going to happen? Let's say if this doesn't happen, are we okay? Are we okay actually, spending that 1 or 2 months, doing this? So once we started having those conversations, once we are clear of, what those things are, what the trade-offs are, then everybody pretty much, got on board.
How did you divide the work the due diligence between the three of you?
Well, we had a fairly big team, right? We had also basically built a team. We had built an executive team. By then, we had investors, right? We had a council, and there's basically three pieces that are there, right? There's the technical diligence that is there, and then there's the sort of the business diligence, all that work, and then the legal thing, right? Basically, sort of shepherding the legal work, right? So that's kind of how we divided the things in the company. We said, hey, this is what okay, technical diligence, take care of all these things, and then we kind of in some ways I try to play the quarterback in certain places. Another member of the management team, he tried to play the quarterback in certain places, etc. So.
Did you guys bring in any advisors, or did you rely on any board members or consultants during the process?
So absolutely, we had a lot of advisors, at Bitfusion, and I had also, one of the things I had also done, during the history of Bitfusion about a year before, we got acquired, is I had also brought on a CEO from outside, after we raised the Series A and scaled to the next level. So he had a lot of experience. He was an exec in a prior company, has gone through this a few times. So we had enough knowledge among the company to kind of take it to that go through the whole process, right? But but it's still a new thing every time you learn new stuff.
Yeah. What was the most challenging part of the process?
A lot of paperwork. Right. So that was literally the most challenging. In fact, even the day before we made the announcement, we were up till 2 a.m. Trying to basically wrap up some of the paperwork between us and the acquirer. So
Crazy.
it was a lot of work, right? A lot of patience, and in fact, one of the things I learned during this whole process is I learned that. You need to have a really good legal team, and we had a great, great set of lawyers. And one of the things I learned was lawyers don't like to talk. They like to email and communicate over email. So one of the things that I learned was you got like and you work in a very different pace as an engineer than lawyers. They want to make sure they are basically managing the risk. They want to make sure everything's done right, but you want to do things fast. So the biggest learning was how do you balance that and still make sure everything is delivered at the right time. So in fact, we sort of actually had a stand-up during the acquisition process with our lawyers.
Were there any surprises during the process?
No, it was actually, there's from an acquirer, it was very smooth. We really enjoyed the process. VMware is great. They were fantastic. Whatever was initially agreed upon is what was we finally. So I personally thought was fantastic. Right, I've heard stories of acquisition where you start with something and then you kind of people try to use that as a way, like anything that you find as a way to negotiate price down and things like that, right? But none of these things happen. So I was really pleased, from that perspective. I would say the biggest surprises were the amount of paperwork and the legal things that you had to do, right? I didn't know a lot of stuff. This was my first, real big process. There are things whatever you write, you got to back it up. You just can't write things, right? So all those things were big surprises for me, and making sure those things there's a contractor that you hired, but then you lost the NDA with that contractor. So I got to go and chase that guy to basically go and get that NDA, or a supplier that you worked with, you didn't close it, right? So you got to go and basically close that thing. So the biggest learning was, have the legal processes very streamlined from day one. Then when an acquisition happens, it should just be a push button. Bam, everything just works.
If only it were that easy.
Yeah.
How did you arrive at the purchase price? Was there negotiations back and forth?
We did negotiate, a little bit, right? There were some back and forth negotiations and everything. It was a good multiple, for everybody. So it was fairly simple for us. So I said I would say, in certain cases, right, it also depends on, we were fortunate and sometimes you get lucky.
Yeah. How long did the process take, the whole due diligence process?
Ours was actually short, right? One of the things we wanted it to be short as well, because we didn't want too much distractions. Ours was about a couple of months. But the thing is, right, we've been working with these guys for a long time, right? We've been working with them for a couple of years before that, right? So kind of knew a lot of things. For example, I mean, in acquisition diligence, there is, the technology diligence, there is basically market diligence, and then is your business, all that business and legal diligence that happens, right? So the market diligence, that was kind of already done because we were kind of in the market jointly already. And the technology diligence also is there because the product has been selling, right? Customers are using it. So there's nothing to diligence on the technology apart from that, right? So it was really mostly business and legal diligence. So it was fairly quick, many of those things were.
Did you guys bring in an investment banker?
No.
No. How come?
I think it all. In my opinion, that depends on the acquisition, price, right? If it's again, I've known stories where even sometimes for like a $500 million acquisition, you don't sometimes bring in an investment banker. But I think unless an acquisition is over $500 million, I just don't think it makes sense to bring an investment banker, right? I mean, there are two reasons you bring an investment banker. One is, hey, it's a $500 million plus acquisition, so any price reduction is going to be significant. So you want the investment banker to be the buffer to make sure all the paperwork, and at the same time, if you're a $500 million plus company, you need to make sure that your operations don't suffer. The investment banker kind of acts as a buffer to do all the paperwork and all the things that I was telling you, the Scrum and all those things, right? The second reason you need it is to source it, right? If you want to go and sell a company and say, okay, hey, investment bankers have connections to talk to people. But we just didn't feel like, we already know what we are doing and we already kind of know what documents and everything that we need to do. So it just didn't make any sense. Why bring in somebody? It only is going to, sometimes it only delays when you bring new people.
Mm-hmm. Did you guys seek out other offers, or was kind of the VMware it just felt perfect? And
it felt perfect. So we didn't, we could have shopped around, if we wanted to. I mean, we kind of, as I said, right, we had optionality, right? So for example, if we didn't want to take this, we always, had the option of going and doing another financing round. And we already had everything lined up for that. So that was kind of our optionality.
Do you think that helped give you leverage in the deal?
Absolutely.
Yeah.
Because I think in every deal, right, not only an acquisition, even when you're selling a product or when you're fundraising, I think BATNA is important, right? The best alternative for a negotiating agreement. So when you have an alternative, you're fearless and you can walk away. And I think, one, you communicate to the other person, but I think more than that, it's kind of a mental framework. And I think people act differently when they are able to walk away from something, right? And you're fearless.
Mm-hmm. One question I ask all my guests on the show is, when is the right time to sell?
I think, it has to be constantly evaluated, in my opinion, okay? So as a founder or as an executive, right, one of the things you have to always question is, how big can I get with what I have right now, and does it make sense? For example, I've spoken to my friends, who have sold their company for $500 million after like multiple rounds of financing, and in fact, even the investors have made next to nothing, right? Because the company didn't grow; they had to just pump in more money. And we have had stories of companies where they've been unicorns, but then it plummets. So I think the question that one has to really answer is, if I don't take this, and I take the other alternative path, am I going to be better off, or am I going to be worse off? And then you basically look at the risks and look at the macro conditions. So I think it's not a single answer, right? It's the best time to sell, and I think there's never a right time to sell, because you never want to sell. Like, you never start a company that you want to sell, right? You always start a company saying that, hey, you want to build $1 billion company, you want to go public, you want to go big, right? If somebody says, hey, I want to start a company to sell, I think that's a wrong way of looking at anything, in my view.
Yeah. Was this a stock sale or an asset sale?
It was a stock sale. It was an all-cash deal.
All cash. Gotcha. Yeah. Do you guys have any problems with minority shareholders at all?
No. In fact, everybody was happy. In fact, every engineer. We were not a large team. We were less than 15 people in our company. So everybody was very happy with the outcome, right? Like, and we're not we have not put in a lot of years in the company. There's basically you've not raised a lot of money, right? And that's another thing that one has to look at, right? When you sell, for example, if you every time you raise capital, I think the bar goes up. For example, let's say if you raise, let's say, a capital of, let's say, $1 million, maybe you can, raise it at, let's say, a valuation of $5 or $6 million. Maybe you can sell the company at 20 million, 25 million, right? That's okay. But let's say you raise, let's say, $5 million or $6 million, and let's say at a valuation of $20 million, right, or $15 million. Now your bar goes higher. Now you have to basically say, okay, I need to sell between $50 and $100 million. And when you raise, let's say, $20, $30 million, your valuation is going to be, 50 or 60 million or 70 million. Now you got to basically sell at like $300 million or $500 million, because VCs always want, like, or any investor, right? People want at least, anywhere from 3 to 10x return, right? And at every point they always want these numbers. So I think it's that price to valuation and how much money you have taken in the company that really determines what do you want to basically sell it for and when that needs to happen, in my view.
What role did your investors play in the process?
I mean, they were all like helpful, like, because investors, they all have gone through this multiple times, right, from a very different perspective, and they kind of actually provided the advice from, how do we negotiate certain things, right? And actually the best thing I always tell other people now also is, you always make the investors a bad guy when you negotiate and say, hey, look, my investor's not going to agree to this.
That's interesting. But were they all supportive, or were there some that were actually saying, don't go for it?
Well, of course, there were investors. I mean, nobody wants to basically sell the company. Everybody wants basically things to go and, hit a home run, right? You basically sell a company for $1 billion, $2 billion, or you go public, right? When somebody invests in a company, they don't say, hey, you settle for, like a 10x exit. You basically say, I want to go for like 100x, right? You go the long run. But at the end, everybody was supportive, right? Because then, we could not even start the process unless everybody's supportive, right? So we were fortunate that, all our investors were very supportive and they were very helpful. At the end of the day, they were supportive of what the company and the management wanted to do, because that's what the company doesn't. Because the way I look at investors are like grandparents. Okay, the management team and founders are like the parents. So grandparents, they come to your house every month and they look at things, they give you advice, they tell you, hey, here's what you do, and the parents are the ones who basically run the show. So it's up to the parents to take their advice or leave everything, or take some advice and leave something, and then still run the house you have, because grandparents leave. And so investors are like grandparents, and fortunately our investors understood that.
That's awesome. What advice would you give to someone thinking of selling their business?
Have options. That's my number one thing, right? Like, for example, if somebody wants to basically say, I want to sell the company, because people don't, you can't sell a company. You won't find buyers who want to buy, right? So people buy companies. So my advice would be, always have options and figure out a way, how you can basically, kind of create options. Even if you don't have options, figure out a way to create those options and then go and, sell it if you really decide to sell it. Because if you don't have options, then you're not going to get the best leverage.
That's great advice. Subbu, thank you so much for your time today.
Sure, happy to.